So, in a recent newsletter from mortgagelogic.news, Rob McClister wrote that no one alive has witnessed a rate move like we saw in 2022, at least on a percentage basis. The next closest move was in 78 when rates in Canada doubled from 8 to about 16%. But there was also much less debt in the economy back then. So, what's different this time?
I'm going to toot my own horn for a little bit. I've always been a little bit of a Fed whisperer because the Fed, for the most part, ignores the financial world completely when it's making policy. It's more concerned with Main Street rather than Wall Street. I don't feel like I've got a good enough grip on the Bank of Canada to know exactly what they're going to do, but let me give you an idea of what I think the Fed is thinking. Interest rates and monetary policy, as a rule, are designed to regulate consumption. By raising and lowering the cost of credit, consumption rises and falls. That's always been the issue. Whether or not it's an appropriate tool for any given moment is irrelevant. That's the tool they have to use. And when the Federal Reserve looks at the demographic structure of the United States, it broadly likes what it sees because the millennials are a large generation that are now buying homes in mass and raising children in mass. And that means our system over the decades to come is very sustainable. And the tools that they have are still going to be appropriate because we're going to have a lot of young people. Young people have the demand. The demand is what they regulate. And so when the Federal Reserve looks at the situation around the world, they really don't like what they see. Most countries are more like Canada, where there just isn't a replacement generation without immigration. And most countries are not Canada and so cannot handle the immigration. Most countries are more like Germany or Italy or China, and we are looking at the end of what we consider normal economics because there are no longer going to be enough young people in the world to carry things forward, whether it's childbirth, tax payments, or economic growth in general. So the Federal Reserve is not primarily looking at today's economic fundamentals in making these decisions with interest rates. I'm not suggesting they're ignoring them. Obviously, inflation is part of the conversation, but they are far more concerned about what happens after the next expansion. Because if you fast forward just 5 years, interest rates won't work in most places. They won't work in Germany or China or Japan or Korea or Taiwan or Thailand at all because there's no more demand to regulate. And in Canada, it will only work if Trudeau gets his way and you're able to import 300,000 to 500,000 new Canadians every year for the next 5 years in order to generate the population that will then generate the demand. They're trying to prepare enough dry powder so that the next time they need to lower interest rates, they have enough dry powder to do it and make a difference because they will be trying to shift the entire world off of the consumption of just one country. And so I don't think they're going to stop until they get to at least 6, because that's kind of the minimum that they've kind of penciled in as to what would allow them to get through the next crisis, not this one.
There's a popular saying, I'm sure you've heard it before, don't fight the Fed. What's the incentive
Rarely
of
a winning
government
bet,
going?
that's fair.
What's the incentive of the government going to be over the next decade and the decade after that?
The biggest challenge the Fed is going to face is as the Chinese and the German systems fail, we need to double the size of industrial plant in the United States in an environment where baby boomer capital is going to be increasingly unavailable. So the credit costs that is necessary when Gen X is the one providing the credit are going to be huge. And so the Federal Reserve has to take steps within policy. I don't know if it's going to be interest rate policy, but within policy to loosen up credit to make that to be an easier process, because the alternative is inflation that's north of 10% for several years. I'm not sure there is a magical policy set that will let that happen, but maybe some version of quantitative easing might. I don't know. We're not just getting out of my skill set here. We're getting out of traditional monetary policy tools because we are entering a fundamentally new era. So paying for that, financing that, at the same time we say we want to do the green transition, and all of that has to be front loaded as well because the 80% of the cost for wind and solar is installation. The fuel's free. Costs just as much over the lifetime as fossil fuels, but it's all front loaded. That all has to be financed. And then, of course, paying for the baby boomers' retirement, because the baby boomers certainly didn't save enough to do it. So those are our 3 big expenses. The last one is lost money. The second one is a political question. The first one is what fuels the United States for the next 60 years. So, all else being equal, I know where the Fed would prefer to put their effort, but the Fed's only one part of our economic management system. Congress gets a say in this, and Congress is the one who decides what happens to Social Security and our pension system and our healthcare system. And none of that is cheap.
Even though you're talking about the Fed, a lot of the major Western countries, central banks all move together. So
That's the thing. Not anymore. One of the things we've seen in this tightening cycle is, yes, other countries have tightened, but only by like an order of magnitude less. The Europeans have barely moved. The Japanese have only moved on paper. Just if you don't have a demographic structure where your interest rates shifts can actually affect consumption, then there's no point in changing them. So
yeah,
you're probably
interesting.
going to see a little bit of movement in places like Sweden that have a better demography than the rest. But there are only two other countries in the world that have a decent demography in the advanced world. That's New Zealand, where we're seeing interest rate moves, and France, which is part of the euro, so we're not.
Okay. Well, so in summary, what should Canadian mortgage lenders, mortgage brokers, realtors, and developers be mindful of as they plan their businesses for the next 5 years?